Welcome back to Prism. I'm Mo Arubai. Last week, we explored an idea that challenges one of the most common assumptions about African development. We asked whether Africa's biggest problem is really a shortage of capital or whether it's actually a shortage of confidence. My argument was simple. Capital follows opportunity, but before it follows opportunity, it follows certainty. Today, I want to build on that idea by asking another uncomfortable question. What if Africa's most expensive tax is not corporate tax, value added tax, or import duty, but uncertainty? Unlike formal taxes, uncertainty never appears in a government budget. Yet, every investor pays it, every business prices it into their decisions, and every economy feels its effects. The irony is that central banks can lower interest rates, governments can introduce investment incentives, and development banks can provide financing. But if uncertainty remains high, businesses will still hesitate to invest. When economies slow, the first recommendation is almost always the same: lower interest rate. The logic is actually straightforward. Cheaper money should encourage businesses to borrow more, and borrowing should increase investment, which should in turn create jobs that should stimulate economic growth. In theory, this is an elegant chain of events. But in practice, it does not always work that way because businesses do not only calculate the cost of money, they also calculate the cost of uncertainty. Imagine I offer you two loan options. The first loan comes with an interest rate of 4%. Sounds attractive, but there's a catch. The currency may lose 30% of its value next year to unpredictable inflation, frequent government policy changes, and unreliable power supply that stifles productivity. Now imagine a second loan. The interest rate is 9%, much higher than the first, but inflation is stable, the currency is relatively predictable, regulations are consistent, and contracts are enforceable. Which investment environment would most businesses choose? Not surprisingly, many will choose the second, not because money is cheaper, but because risk is easier to understand. That is the difference between the price of money and the price of risk. Governments spend years debating tax reform to corporate income tax, VAT, and import duties. But there's another tax that almost nobody talks about, and that is the uncertainty tax. The uncertainty tax manifests in the investment that never happens, the factory that is never built, the entrepreneur who delays expansion, the multinational company that chooses another market, and the bank that decides to hold liquidity instead of financing new businesses. These decisions do not show up in fiscal reports, but they do have enormous economic consequences. Every delayed investment means fewer jobs, lower productivity levels, less innovation, and slower economic growth. This is why I describe uncertainty as Africa's most expensive invisible tax. It is paid daily, even though no government officially collects it. History offers an interesting lesson in Europe. Europe did not become wealthy because it eliminated risk. Merchants faced piracy, ships sank, wars disrupted trade, and markets collapsed. Risk was literally everywhere. The difference was that Europe gradually built institutions that could manage risk. From marine insurance to commercial courts, reinsurance, reliable contract enforcement, and predictable banking systems. These institutions gave businesses something incredibly valuable, and that was confidence. Investors were not betting on a risk free economy. Rather, they were investing in an economy where risks could be managed, priced, and transferred. Prosperity is not built by eliminating uncertainty, but by managing it better than everyone else. This brings us to the role of insurance in ensuring financial system stability. Most people think insurance exists to pay claims after disasters occur. But from a macroeconomic perspective, insurance does something much more important. It changes behavior before disasters occur. When businesses know they can insure their factories, warehouses, exports, equipment, supply chains, or even business interruption losses, they are more willing to invest, banks become more willing to lend, and investors become more willing to finance long term projects. Overall, insurance reduces the cost of uncertainty, and when uncertainty falls, confidence rises. That is why I believe insurance is more than just a financial service. It is economic infrastructure, just as important as roads, electricity, and functioning legal institutions. Perhaps this is why monetary policy sometimes appears less effective than expected, because central banks control the price of money, but they do not control the price of uncertainty. And unless uncertainty falls, lower interest rates alone may not unlock sustained economic growth. So the next time someone argues that Africa simply needs lower interest rates, ask a different question. Will cheaper money matter if businesses still fear tomorrow? Because sustainable growth does not happen when money becomes cheaper. It happens when the future becomes more predictable. Perhaps Africa's greatest competitive advantage will not come from discovering more natural resources or attracting more capital. It could come from becoming a continent where uncertainty is managed better than even before. In our next episode, we'll explore another overlooked reality, Africa's climate paradox, and why the continent that contributes the least to climate change may pay the highest economic price. We will examine how climate change is no longer just an environmental issue and is becoming one of Africa's biggest macroeconomic and investment risks, and why building climate resilience may be one of the smartest economic strategies of the 21st century. Until next time, remember, every economy tells a story, but not always the one you think. I remain Mo Arubai. Thank you for listening, and I'll see you in the next episode of Prism.